Good morning and welcome to this press conference where we will present Equinor's fourth quarter and full year results. It has been a while since we have had a press conference in London, so we are very pleased to meeting you here. My name is Sissel Rinde and I'm heading up media relations in Equinor. If an emergency situation should occur while we are here, the evacuation signal is a voice system announcement. Please note, we only evacuate the building should the voice announcement say to do so. Then, please use the sign-posted fire exits within the venue. Follow the signs and messages from the guards. Exiting is at ground level. Venue staff will show you the way to the assembly point. After the presentation, there will be an opportunity to ask questions in plenary. Please raise your hands and use the microphones handed out by my colleagues. Then there will be some time for separate interviews of the CEO and the CFO. And with that, I will welcome Equinor's CEO, Anders Opedal, on the stage.
Thank you very much, Sissel, and good morning. Good to see you all, and welcome to our press conference here in London. Later today, we will, at our Capital Markets Update, we will share the progress on our strategy and the ambitions, as well as our financial results. But before we begin, let me just say that our thoughts go to everyone suffering after the terrible earthquake in Turkey and Syria. We will donate funds to Red Cross and UNICEF to support the relief effort. 2022 was truly an extraordinary year. The war in Europe, still causing human suffering, and a disrupted energy market contributed to inflation and a cost of living crisis. Equinor responded quickly, and we are well positioned to be part of the solution. Short term, to deliver the energy needed, longer term, to build up sustainable energy sources, contributing to energy security and decarbonization. This leads me to the topic of our capital market update, how we will deliver strong returns through the transition. We have progressed on our strategy, producing oil and gas with low CO2 emission, while stepping up investments in renewables and low-carbon solutions. Equinor is transforming as a broad energy company, progressing on the energy transition plan. We are well positioned to create value. In a $70 Brent scenario, we expect to deliver a very strong cash flow from operations. On average, around $20 billion after tax annually, all the way to 2030. We estimate an annual return of capital employed above 15% towards 2030. This strong outlook and solid financial position funds increased capital distribution and continued investments in profitable projects. For fourth quarter 2022, we step up our capital distribution to shareholders and propose a 50% increase in the ordinary cash dividend to 30 cents per share. In combination with extraordinary dividend and share buyback, we expect a total distribution to shareholders of around $17 billion in 2023. I will revert to this, but let me first present our results. On safety, we have achieved improvements on key indicators over several years. Our serious incident frequency of 0.4 was stable from 2021, the best level so far. We continue to work with the clear goal, all our people returning safely home from work every day. Last year, we enhanced security within cyber and for our assets. Stricter security protocols, more training, and closer collaboration with authorities. All of this to safeguard our people, operations, and security of supply for our customers. Sustainability is all about making progress for society. We are committed to creating local value, equal opportunities, and protecting the environment. In 2022, we responded to the energy security situation by boosting our gas production and shipping more crude to Europe. I'm proud of the hard work from colleagues to ensure safe and reliable supply of energy. This is a true team effort. And during the year, 2,600 new colleagues joined Equinor, replacing and renewing competence, demonstrating our attractiveness in a tight labor market. Last year, we delivered strong operational performance. 7 new fields on stream at a capacity of more than 200,000 barrels per day, around half of this from Johan Sverdrup Phase 2. In addition, we have put our floating wind farm, Hywind Tampen, in production on NCS. Based on strong operational performance and high prices, we delivered record returns. Our net operating income came in at $79 billion and adjusted earnings at $75 billion. This clearly demonstrates our ability to capture value from high prices and volatile markets. Across the portfolio, we have progressed on projects to reduce our own emissions. Our CO2 intensity ended at 6.9, well below half the industry average. We are progressing on our project for decarbonization with CO2 transport and storage, including the Smeaheia license on NCS awarded last year. We have an acreage to store around 30 million tons CO2 annually. In the fourth quarter, despite European gas prices falling, we delivered a strong net income of $7.9 billion and adjusted earnings after tax of $5.8 billion. No company, including Equinor, is shielded from the inflation and cost pressure in our industry. Our operating costs are impacted by inflation, energy costs, as well as prices and taxes for CO2. In the US, we reverse impairments of $350 million, and for Mariner in UK, we reverse impairments of around $750 million. This is due to higher expected value creation as well as higher price assumptions. Our strong earnings and outlook in US has allowed us to book a deferred tax asset of $2.7 billion originating from historical losses. This makes our reported tax rate for the quarter lower in relative terms. I must also highlight our MMP segment this quarter. Without the negative derivative timing effects, adjusted earnings for MMP would have been $1.8 billion. In MMP, Triton Power delivers strong results, more than twice the acquisition price. We deliver a net cash flow above $23 billion after tax, capital distributions, and investments. Organic investments ended at $8.1 billion, and distribution to shareholders at 8.7 billion. With strong earnings comes higher tax contribution to society. On the Norwegian continental shelf, where most of our earnings come from, we paid more than 420 billion Norwegian kroner, or more than $42 billion last year. There is a delay in the Norwegian tax bill, and in total for 2022, we will pay close to 477 million kroner, or $47 billion. A record to be proud of in a very special year behind us. The energy transition must progress in a balanced way, ensuring energy security, affordability, and decarbonization. Our strategy serves us well and is as relevant as ever on the way to net zero. We are in a unique position to create value, providing energy security and decarbonization. In 2023, we estimate a 3% production increase. By the end of the decade, we expect the production to be on par with today, while delivering a 50% reduction in our emissions. The estimated production will secure long-term supply of gas from NCS to Europe. We expect the average annual production to be above 40 BCMs throughout the decade. And our piped gas to Europe have less than 1/5 of the CO2 intensity compared to LNG imports. In renewables, we continue a profitable and disciplined growth. Our California lease serves as a demonstration of our ability to put value over volume. Later this year, we will start production from the first phase of Dogger Bank here in UK. The first phase has a capacity of 1.2 gigawatt alone, and in total, the Dogger Bank phases can power 5 million UK homes. As renewable projects start production, power generation will grow rapidly, and we will prioritize the projects bringing the best returns. We expect to grow our annual production from the 1.6 terawatt hours today to between 35 and 60 in 2030. To add some perspectives, this is enough to power 9 to 15 million UK homes, or around a third of the Norwegian hydropower production. Equinor has safely stored CO2 for almost 30 years in the Sleipner field. We introduced low-carbon solutions as a part of our corporate strategy in 2021. Since then, we have made strong progress. For our projects and plans in Europe and US, the recent policy development will strengthen the commercial potential. We see growing interest in CO2 storage and hydrogen from industrial customers. Last summer, Northern Lights on NCS signed its first commercial agreement. In UK, our East Coast cluster was shortlisted in the government cluster process. And in January, we announced a cooperation with RWE in Germany for energy security and decarbonization. Together, we aim to help Germany transition from coal to gas to low-carbon hydrogen, and finally, hydrogen from renewables. Our liquids, gas, and power production is high, but far exceeded by the volumes we sell and trade. Last year, we sold more than 800 million barrels of liquids, 100 BCMs of gas, and traded more than 175 terawatt hours of power. We optimize and create value from production, our infrastructure, and the volumes we sell and trade. On top of this, we will provide decarbonization through CCS and hydrogen. Going forward, we are set to continue capturing high value from volatile and tight markets. On the back of this, we increase our guiding for marketing, midstream, and processing by 60%. Creating and capturing value across our business, we estimate a free cash flow over the 4 years to 2026 of around $25 billion. The energy transition will be demanding with difficult dilemmas. We believe in a balanced energy transition, and Equinor must solve for three things: reduce emissions for ourselves and our customers, build up new energy sources, and secure reliable energy. We will work hard to deliver on this and at the same time create value for shareholders and society. We continue to cut our emissions from operations. Since 2015, we have cut almost 30% of our emissions on the way to net 50% reduction in 2030. The share of gross investments in renewables and low carbon is on track to a 30% share by 2025, progressing towards more than 50% in 2030. We are also progressing on our energy transition plan and remain committed to the ambition of net zero. Our strong cash flow outlook, continued capital discipline, and robust balance sheet is the basis for the increase in the capital distribution. To me, it is important that the step-up provides highly competitive distribution for 2023 and increased predictability and commitment in the long run. The board proposes a 50% increase in the ordinary cash dividend from 20 to 30 cents per share for the fourth quarter. Our dividend policy remains firm. We expect to increase the annual ordinary cash dividend in line with long-term underlying earnings, now from a higher base. In addition to the ordinary cash dividend, now above pre-COVID levels, share buybacks are an integrated part of our ordinary capital distribution. We continue the program we introduced back in June 2021 of $1.2 billion per year. The record earnings last year, our strong financial position, also enables extraordinary distribution to shareholders in 2023. We propose an extraordinary cash dividend of 60 cents per share for fourth quarter. This will bring the total quarterly cash dividend to 90 cents per share, subject to AGM approval. The board is clear in its intention to maintain this level for the first 3 quarters of 2023. In addition, we propose an extraordinary buyback of shares of $4.8 billion, making it $6 billion for the year. In total, this leads to a capital distribution to shareholders of around $17 billion in 2023. So let me sum up. We are uniquely positioned to create value by providing energy security and decarbonization. We reaffirm our commitment and step up capital distribution while investing in our profitable portfolio. We can deliver the energy needed while driving the transition to low carbon future. Thank you all for the attention, and then I hand it over to you, Sissel. Oh, there you are, Sissel, and look forward to questions.
Thank you, Anders. Okay, then it's open up for you. If you raise your hand, you can ask questions in plenary. And I see you first from Finansavisen and Marius Lorentzen.
Two questions. One on your prediction about European gas deliveries, and the second one on capex. Before, you've said that you expect to deliver at least 40 BCM annually to Europe until 2026. Now it seems you're saying to the end of the decade. Have you updated your assumptions on your production capabilities from the Norwegian continental shelf? And the second question is about your capex. Your increase from 12 to 13 billion in the coming years. Is this inflation driven, or have you changed your mix in your projects portfolio?
First of all, we have always developing resources on Norwegian continental shelf. We have an exploration program. We will explore between 20 to 30 exploration wells every year. In 2023, we will have around 25 exploration wells on the Norwegian continental shelf. You know, with these maturing resources, developing subsea tie-in projects, exploring, we see that we can maintain the production level at a high level up to 2030 and even beyond. Then, regarding capex, we have included the inflation into our capex numbers that we have seen over the last year. And then, as we have guided on before, we will gradually ramp up our investments in renewable as we mature the projects and we sanction them. So you will see that it's driven by our increased renewable portfolio, but also that we maintain a very high and stable capex for our oil and gas portfolio.
Okay, questions over there.
Thank you. Hi, Rachel from The Telegraph. First question, do you envisage increasing gas deliveries to the UK in coming years? And if so, by roughly how much? And secondly, do you plan on going ahead with the Rosebank project in the North Sea? Thank you.
Well, as you will see from our production guiding, we're increasing it for the 2023. This is due to the ramp-up of the Njord and the Johan Sverdrup field, which is liquid. As I mentioned, 40 BCM all the way to 2030. This means that stable flow of gas from Equinor and the Norwegian continental shelf, and that means energy security to UK. No plans to significantly ramp it up, but to have a stable, reliable gas coming to UK. And then we are progressing on the maturation of the Rosebank projects, and we will come back to any sanction at a later stage with Rosebank.
A question over there.
Morning. I'm Deb Kelly from Energy Intelligence. Where do you see the bottlenecks in terms of reaching your 12 to 16 gigawatt renewable target? And then secondly, you've spoken previously about making changes to the way the renewables business is run for it to be competitive and have sufficient freedom to develop. Can you talk about what those changes are and how it will improve that business? Thank you.
Yeah, as you said, our target 12 to 16 gigawatts is the target we maintain, but today we will more present, the power production from this potential of 12 to 16. And we will continue developing the renewable portfolio. We have a broader set of opportunity set now after progressing this. We have access 14 gigawatts into our portfolio. This means that we can select the best project and how we progress them further. And also, just for your second question, we have given the renewable unit more accountability, running it a little bit more like a company in terms of financial results, and that's why we now measure them on the power production. And they will then also take more responsibility for project execution and procurement and really drive a profitable growth in renewables. So that is what we want to get out of that.
Kjetil Malkele Sovland, E24.
Yeah, thanks. You are talking about you're adjusting the medium-term price outlook, and you're hiking the expectations for oil price and especially gas price. Can you say a little bit about the short-term development of the oil prices and why you are increasing this now?
Well, the oil market going forward is quite volatile. We see that it's very little spare capacity. There are several unknown factors going forward. You know, the economic return of China after COVID. You know, how Russia will develop. You know, with the sanction. So we see a tight market and volatile market going forward, and that is the basis for our price assumptions.
No more questions here. Okay, I see one over there. You're welcome.
Hi, I'm Stanley Reed from the New York Times. Just would be interested in what your outlook is for gas in Europe, you know, over the next year or two. Kind of what your assumptions are.
Well, at the moment we see some unprecedented warm winter, which that keeps the storage level quite high, and Europe will make it through this winter. Most likely also be able to refill its storage for next winter, but that will require a further reduction in demand, and it will require a massive import of LNG. So that means that really the LNG import will be one of the critical factors. And then, the unknowns here are, of course, then further the weather, both in Europe and Asia. And I think also any supply disruption will have impact of the market. So I would say it's a little bit of a nervous market going forward.
And a question over there.
Thank you. Davide from Upstream. Just a couple of questions. The first one, is there anything you can tell us about the development of the Brazil BCM 33 and the Pau de Açúcar project this year? And the second one is that what are your expectations for your returns on renewables this year? Are you satisfied with the rate where you have, and do you think you can enhance that further? Thank you.
As Rosebank, BMC 33 is also progressing toward FID, but it's too early to say when and so. And also on the returns, we maintain the 4 to 8 returns on project level real. But with a broader set of portfolio, Paul and his team can really drive and prioritize the project with the best return all the time.
Okay, one more question to you, Rachel.
Thank you. Sorry, I just wanted to pick up on Stanley's question. And you mentioned that in order to refill storage for next winter, there'll need to be a further reduction in demand. Could you just elaborate on what sort of further demand reduction you think we'll need? Thank you.
No, that's more general. Kind of, we just see that the gas demand needs to be lower to be able to refill at a certain level, as Russian gas will be less, available in 2023 compared to the beginning of 2022. So that goes across for consumers and industries.
A question to Mikael Holter in Dagens Næringsliv.
Thank you very much. Just reverting to CapEx, this is a sort of a follow-up. I think I heard you correctly when you said that you had baked in your new assumptions on inflation into those new CapEx guidance figures. Can you get into whether there is any of that that's in the increase compared to the guiding that you provided last year? Is there any of that that's linked to an increase in activity compared to what you foresaw a year ago?
Well, I think you should see the CapEx guiding this year, 10 to 11, is in line with the guided range we had last year. So inflation is baked in there, and we have a long-term project plans. You also see we are guided up for later years last year, and we do the same this year. This is about activity increase as we mature the projects.
Okay. Then we have a question from Halvor Ripegutu, Nettavisen.
I was just wondering, can you elaborate a bit more on you made a pretty significant, well, you made a loss on renewables. Could you elaborate a bit on the underlying factors there?
Yeah, on the underlying factors for
the reasons for the loss making in the renewables for last year, which.
Okay, so for the producing assets, we are making money, but we are in a vesting phase, meaning that after the income we have expenses that goes on the P&L, and that's why we make a loss on the renewables. This is planned, and that will happen as long as we are in this investing phase. But this year, our income will increase as Dogger Bank A is coming on the first power, and gradually the Dogger Bank A, B, and C will come each year, 23, 24, and 25.
Thank you. We close this session now, and then it will be possible to one-to-one interviews with Anders Opedal and also the CFO, Torgrim Reitan. So thank